Hello, I'm Patrick Manzi, Chief Economist with the National Automobile Dealers Association, here to give you an update from the first quarter of 2022 and an outlook for the rest of the year. Now, spring has come very quickly and a lot has changed in the world. Let's start first with a discussion of the new light vehicle market. New light vehicle sales in March totaled a SAAR of 13.3 million units. Sales decreased each month in SAAR terms throughout the first quarter. Now, when you average the sales across the first quarter, the SAAR totaled 14.1 million units for the first quarter of 2022. Now, while this performance is lackluster when comparing it to previous first quarters from just a few years ago, it was the best sales quarter since Q2 of last year. The story in Q1 is much the same as it was for the last two quarters of 2021. Sales continue to be limited by available inventory. Vehicles are selling very soon after they reach dealer lots, and dealers have order books of sold orders stretching out several months in an effort to get vehicles to the customers who want them. Now, because of this tight market, vehicle prices have risen, mainly because OEMs have severely reduced their average incentive spending per unit. According to J.D. Power, average incentive spending per unit is expected to reach an all-time low of $1,044 per unit. A big reason incentive spending has been driven so low is that OEMs have pulled back on their incentive spending for leasing. Now, back in 2019, leasing accounted for roughly 30% of all sales, whereas at the end of March, it's on track to account for just 18% of sales, as many customers come back with their off-lease vehicles and realize that a traditional finance contract may be a better deal to keep their monthly payments down. Now, new vehicle average transaction prices have risen fairly significantly over the past quarter. According to J.D. Power, in the first quarter of 2022, average vehicle transaction prices are expected to top $44,000. This is up roughly 18% compared to the first quarter of last year. Average monthly payment growth has been limited somewhat because consumers who walk into a dealership with a trade-in suddenly have a lot more equity in their vehicle. Looking ahead to the rest of the year, the Federal Reserve has said that they were going to begin an aggressive path of increasing the federal funds rate. As the Federal Reserve increases the federal funds rate, this is going to increase vehicle financing rates for both new and used vehicles. For the past 2 years, low new and used vehicle lending rates have been a tailwind for consumers' average monthly payments. But going forward for the rest of the year, as the Fed hikes rates, we expect that that interest rates are going to transform into a headwind. In the first quarter, light trucks, and by light trucks I mean crossovers, pickups, SUVs, and vans, accounted for nearly 80% of all the new vehicles sold. OEMs have been prioritizing production of these popular light truck models, and within those light truck models, they have been prioritizing production of higher trims. This too has contributed to the increase in transaction prices we're seeing across the industry. Now, we've also heard about gas prices rising. Gas prices are now over $4 a gallon in pretty much all parts of the country, and we expect that they're going to remain above $4 a gallon through at least the summer months. And while it's probably still too early to see any effects from these higher gas prices, we have already seen a shift of consumers towards more alternative fuel powertrains. For example, battery electric vehicles accounted for 4.5% of all new vehicles sold in the first quarter. That's up from 2.9% in all of 2021. Now, perhaps the biggest issue out there for dealers is new light vehicle inventory. Inventory isn't expected to change too much by the time we get final data for March. And for the rest of the year, inventory is likely going to remain severely constrained due to the ongoing supply chain issues seen throughout most of the world. The war in Ukraine has also contributed on the margin to these supply chain issues, and as well as the ongoing semiconductor microchip shortage. Inventory is unlikely to top 2 million units before the rest of the year, and vehicles are likely going to continue to sell quickly after they reach dealer lots. Our forecast for the rest of the year is for sales to total 15.4 million units. Now, there are still some risks to the downside here. There could be further supply chain disruptions, and it could take longer for those supply chain disruptions that are already out there to be dealt with. But still, we remain confident that our franchise dealer members are going to have another solid year for both new and used vehicle sales, as well as strong performance from their fixed operation department. In the U.S. labor market, we saw another stellar jobs report in March. The U.S. economy added 431,000 jobs, and the quarterly average for job gains in the first quarter of 2022 totaled 562,000.
The economy has created more than 500,000, more than 500,000 jobs.
Just really stellar performance, despite the impact from these global supply chain issues and the Omicron variant back in January. The unemployment rate also fell to a post-pandemic low of 3.6%. If we continue this pace of job growth for the next few months, it's highly likely that we will have gotten back all of the jobs lost over the past 2 years by the summer months. Now, with such strong demand for labor, many workers have been able to negotiate significant wage increases throughout the year. Now, despite these really solid wage gains, inflation has been outpacing wage gains for many American workers out there. And because of that, many American workers are looking around and seeing higher prices for everything around them, from vehicles, rents, housing, food, and gasoline prices, just to name a few. This has caused many workers to be concerned that their real incomes are going to actually decrease as a result of this high inflation. Because of this, consumer confidence has been driven to its lowest point since August of 2011 because these prices are so high. Now, the Federal Reserve has also noticed this and has significantly changed their posture on reining in inflation. We now expect that the Fed is going to raise the federal funds rate much higher than they had suggested even just 3 months ago. Now, given the recent shocks to the economy and the change in posture by the Federal Reserve, we have reduced our forecast for real economic growth this year. For all of 2022, we forecast that real GDP will grow about 2.9%. For the first quarter of 2022, we expect real GDP is going to grow by about 1 to 2%, and then GDP growth should pick back up in the second quarter before cooling again in the third and fourth quarters of the year. Now, looking ahead for the rest of the year, many of our forecasts face significant downside risk stemming from the ongoing semiconductor microchip shortage, other supply chain disruptions, global conflicts such as the war in Ukraine, and still lingering effects from the COVID-19 pandemic. Despite these challenges, we remain confident that 2022 is still going to be a solid year for our franchise dealer members. And that concludes my 2022 Q1 economic update. Wherever you are, I hope you and yours are well, and I wish you continued success this year in your business.